Welcome to Stock Watch with me and Taoleng Lechela, and joining me to unpack your stock-related questions today are Mark Du Toit from Oyster Investments and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Gents, thank you so much for your time this evening. A lot happening today, and we've seen a major rotation out of tech stocks. Shane, software companies in particular hard hit, wiping out about $1 trillion as investors start considering how AI advances might affect those companies. I don't know, are those concerns valid, or is this route a little bit over-exaggerated?
So I'm telling the US software index has fallen from, and this is an aggregation of all companies, I mean, the biggest in them being Microsoft, Palantir, and so on. That has fallen from about 105 to 85, and that has happened in a very short space of time. And clearly the risk, or the perceived risk, is that some artificial intelligence application will disintermediate these software companies, that maybe you won't need to buy software, that you will be able to use some AI application in place of that software. So it's had a significant impact. It's very hard to know, but I mean, my judgment is that these are big shares that have fallen quite a long way.
Yeah.
And probably you're getting into buying territory.
Exactly, and that's what I was about to ask Mark, whether this is just a normalization of these counters. I mean, they've run for quite some time.
Yes, I also think that we're seeing a bit of a rotation from a sector that's done very well for 15 years now into a more broader share base. Seeing people moving money out of stocks that they've done very well in into more real-world economy types of investments, and trying to take advantage of the higher GDP growth rate that Trump and the Republican Party are trying to stoke there in the US. So maybe a bit of a rebalancing of portfolios.
Yeah.
I mean, last year we saw money coming out of US bonds and going into things like gold to diversify our portfolios. I'm sure we'll talk about it, but it seems like that's a little bit on the back foot post the sharp rise in January.
Yeah, that the precious metals losing steam. That rally we did see from last year going into this year has been losing some steam over the past week. Also, gold counters, silver also in the red, PGM counters also taking a knock. Talking about miners, I want us to get into that Rio Tinto Glencore deal. Shane, you just let me know that it's been scrapped.
So there was news in London shortly after our close that negotiations have been discontinued. The proposal was a merger between Rio Tinto and Glencore, but the market perception was that there would be some kind of premium paid for Glencore. About 40% of Glencore's assets are copper, and about another 10 is silver. And they had, I think, dressed themselves up to be taken over. And the perception in the market was that there would be a price in rands north of 120. The share fell 5% before our close, so I guess there must have been some leak.
Yeah,
and it fell another 5% in London.
What does this mean for BHP? Do you think they might come to the table and maybe make an offer for Glencore, Mark?
I mean, it is possible. I guess that we know that Billiton would like more copper in their portfolio, and then they further out, sort of 10 years out, they do need more copper projects. So I mean, it is possible, but the culture between Billiton and Glencore, and even Rio and Glencore, the organizations have very different cultures. Glencore is seen as a far more aggressive type of business, and the Billiton and Rio are more focused on operations and mining. So I think that any kind of mergers is going to be tricky because of the different nature of the organizations.
But consolidation is still on when we look at the mining sector, particularly around the critical minerals, around the industrial metals.
Yes, definitely, yeah.
Okay, all right. Let's move over to Naspers. There's a question here around Naspers and Naspers process share price coming under pressure over some time. Both counters in the green today, the last time I checked. But I'm wondering whether the downturn we've been seeing this week, Shane, is on the back of the tech sell-off, perhaps, you know, being fueled by Tencent and then filtering through to Naspers process. Anything to be worried about, or just on the back of what we're seeing over in the tech sector?
Mtaling, maybe if I can segue into what Mark was saying about a sell-off in US tech, and he's right. I mean, US tech has had, you know, give or take 15 years of very strong growth. And that has been accompanied at least partly by money flowing into the US stock market. Over the last 15 years, the US stock market has gone from 40% of global stock markets to 65% of total market cap. And that process, because of various things, including the policies of Trump, is reversing to some degree.
Okay.
So the big tech companies are based in the United States, and money is flowing out of the United States. In fact, on a net basis, no money has flown from the rest of the world into US equities this year. So to the extent that for US shares to go up, they require inflows from the rest of the world, that's not happening. On Naspers process, I mean, you're right, the shares are down 15, 16% for the year, which is kind of surprising. But I mean, there has also been something of a sell-off in China tech, and Tencent is also down. So I wouldn't describe it as abnormal, but I think our view would be that this is probably a buying opportunity in Naspers and process.
Does the weaker or the weaker dollar, stronger rand dynamic also play into, I guess, a counter like Naspers process, Mark?
Yeah, I mean, I would say partly because in rand you're earning less, although, you know, Tencent is a Chinese business, so it's more the rand versus the renminbi translation. I think that also recently we've seen announcements in China on increasing VAT in the telco space, and there was a little bit of a worry that that could spill over into a broader increase in taxes, which maybe meant that the whole Chinese stock market came out under a bit of pressure, and Tencent was not immune to that. And then Tencent also had a little glitch with when they launched their new AI module in WeChat, and WeChat decided that the AI module was spam and blocked it. So that was like a little hiccup that they needed to sort out. But also I agree with Shane. I mean, we think that the share price has come off quite a bit.
Yeah.
It's actually starting to show nice value now for South Africans to buy process in Naspers.
Shane, you mentioned there that this presents a buying opportunity, and I want to perhaps pick your brain around the Chinese tech sector as a whole, and with this rotation we've been seeing out of America into emerging markets, which counters they pique your interest? We do know of the likes of a Tencent, and you can get that through Process and Naspers.
Telling so, you know, the emerging market sector is actually quite small. But the total global stock market, the emerging market sector is a very tiny fraction, but the largest part, of course, is China. China is about, call it 30% of the total emerging market index. They also have the majority of the large tech stocks based in China. Most of them that we are able to access are listed in Hong Kong. But as Mark said, there have been some, let's say, self-inflicted wounds in the Chinese market. There have been some company-specific issues like the WeChat issue, and then there have been some regulatory issues. The VAT issue Mark mentioned, and then of course there was the anti-competitive, or rather the Competition Authority investigation into Trip.com. And investors have a fear that this may be a reignition of a rising regulatory cycle in China, like happened in 2021. You recall when they attacked the private education businesses and so on.
All right, let's move over to the GLP-1 market. Question on Novo and when the tide will change for that counter. Just reflecting on the numbers and the outlook, it was pretty downbeat. Yes, there's the perception that we'll see further growth on that front because of the oral pills. But what did you make of that the numbers we got out earlier this week, Shane?
So the Novo numbers were disappointing, and I mean, I can name 4 or 5 fund managers globally that I know that are long Novo and short Lilly, and that has been an appalling trade. In fact, Lilly was up 10% last night in the United States. So clearly there's some company-specific issues at play, and it appears that Novo is not getting the traction that Lilly is getting at the present moment.
So clearly more company specific on that front. Let's get your your views around that sector, Mark, looking at Eli Lilly in particular, posting better numbers than Novo. Also, what do you think of a player like Pfizer in that field? Yes, investors didn't necessarily like the numbers as much, but kind of appearing as a player that might grab some market share if they do get things right with Metair.
Yeah, I think that, I don't know in depth the detail behind these companies, but one thing I would say is that in the pharmaceutical space, it's always about the next drug that you're bringing to market. And I think that there is a fair amount of risk in that, it doesn't come to fruition, the market share gains and the efficacy of their drugs, and there's a whole approval process that needs to go through as well. So it is quite a difficult sector to analyze. And big offshore guys, we don't look at the detail of it. So right. I can't tell you between the 4 which one to buy.
Gents, maybe let's start with MTN doing a 180 today, announcing that it's looking to acquire the stake in IHS it doesn't already own, which is about 75%. A surprise move after it sold towers to IHS and supported its move to list in the States. How are you interpreting this potential move, considering that there's this capital light shift when it comes to those telcos players, Shane?
So I'm telling you, absolutely nailed the situation. I mean, people are upset to some degree because they perceive MTN moving to a more and more capital heavy business. In telcos, you have these MVNOs, these virtual telcos, that have almost no capital, and they have a very high return on capital as a result. By entering or buying the towers, MTN becomes a capital heavy business again. And then the second problem is, because they're going to have to come up with the cash for the IHS tower business, it probably delays any other further corporate activity that MTN could do, like the purchase of OpenServe or indeed the whole of Telkom.
And your thoughts around that potential acquisition corporate action on that front, that share price down 5.7% today?
Yeah, I guess that it was a surprise, obviously, to the market as a whole. It brings into question kind of the strategic next step for MTN. It seems that there's more focused on perhaps West Africa again. I think the market is surprised. Any kind of acquisition, you always worry that the acquiring company is going to overpay. And in this case, it's also almost a change in strategy, which we were not expecting. So it'll be interesting to hear more from the company as to why they felt the need to do it. Yeah.
I'm going to stick with you for a bit, Mark. A question here on Orion Minerals, a share that is going to explode in value in the near future. This is a question, right? If I remember correctly, I think they just got some backing or funding from BHP, right? Earlier this week.
I'm actually not sure about the backing from BHP, but Orion Minerals owns some nice copper projects. It is a smaller mining company, focused, their projects that they have are in the Northern Cape. And I guess my concern a little bit around the junior mining space is often there's a much longer time before a company is able to realize the projects and the value that it has. Typically the capital projections are normally too low. The company requires more capital than everybody expected, and it takes longer to bring these projects to market. which is why we normally a little bit hesitant in the junior mining space. If the copper prices keep going up like they have been going, then the company will do obviously very well, and there's also potential it could be bought out by a larger mining group. But yeah, it's very speculative in my view.
Okay, let's move over to the retail sector. Shane, let's get your thoughts around Boxer's trading update. Seemed to surprise to the downside, even within that Black Friday period. Also reflecting on ShopRite's numbers, also surprising to the downside. Is this a story around a consumer that's under pressure? Are we probably seeing margins being squeezed as we also see low food inflation? What's happening on that front?
I'm telling, so these are not company-specific issues. These are macroeconomic forces that are very negative for the retailers, particularly, as you mentioned, the food retailers. The problem is that for decades, South Africa had inflation, let's say, between 7 and above 10%. That meant that every year a food retailer, without doing anything, it would grow its earnings by 10% or it grow its revenue by 10% because of inflation. Now we have lowered the inflation target band to be 3%, and inflation in food is less than 3%. It's probably somewhere between 1 and 2%. So these companies that would just by doing nothing grow their revenue by 10% are now only growing it between 1 and 2%. On top of that, it's become a very competitive environment. ShopRite rolled out 400 stores last year. So it's a kind of a collision of two negative factors: too much space and no inflation.
And I'm wondering if, counters like ShopRite and Boxer are, struggling with that. What could happen to counters like Spar and even Pick n Pay, Mark?
Yeah, I mean, in a tough environment, the stronger counters do better. I mean, Pick n Pay and Spar both have their own issues that they're dealing with. Spar is dealing with a SAP implementation that went quite poorly, and struggling a lot to implement any kind of competitor to the 6060 from Checkers. Spar's got a lot of unique products in their stores, and there isn't one kind of central point where all the inventory is kept, so it's been a lot more difficult for them to roll out the delivery kind of competitive to 6060. And Pick n Pay is still dealing with years and years of poor cost control in the business, and the business is being restructured and right-sized now. Pick n Pay actually looks quite interesting just because the business, if you include its holding of Boxer, the remaining value is quite attractive, and potentially there could be a buyer that comes to market for Pick n Pay.
Do you think Pick n Pay is attractive at this level, Shane? I mean, yes, we do see the likes of a Pick n Pay clothing, all the other stores doing well. It's just the Pick n Pay brand, the supermarket, really under pressure.
So I'm telling, my job as a fund manager is to in the first instance say whether a company is good or bad and doing better or worse.
Yeah.
But then also to say, are other people going to buy the share and agree with me? And I think the retail sector has become a sector with problems. If you go back 5 or 10 years, all the retailers were doing well. Now, if you look at the recent trading updates, ShopRite disappointed, Boxer disappointed, Mr. Price has got this appalling acquisition in Eastern Europe. Fashini put out a terrible trading update at the end of last year. The share was down 20% within 10 days. The Truworths trading update, at least as it relates to South Africa, wasn't that good. And Clicks, who has been, I guess, the safe harbor in the sector, themselves put out a trading update that was disappointing, and I think the share's down 10% since then. So this is a sector that has problems. Having said all of that, it's starting to look maybe interesting in terms of valuation now, but this is certainly a place where there have been some problems, and not all the companies are through their problems.
Is it a problem around the consumer? Is it a cash-conscious consumer? Is it a tough consumer environment, Shane?
Well, I think it's a combination. I think that it's a combination of poorly judged acquisitions in some instances, poorly executed SAP systems in others, and then the environment doesn't help. Clearly, in a tough environment, you cannot afford to make mistakes.
Yeah, let's move over to another counter question coming through on Metair, Mark. Is there a future or not? Just to add on there, Metair's aftermarket segment, has it been impacted by the influx of Chinese vehicles? Are those dynamics playing out in that company as well, Mark?
Yes, I think it is a difficult space for Metair. I mean, I don't think that there's any kind of imminent, there's no balance sheet issue there, but certainly is a difficult space for them. And we're seeing Chinese cars coming into South Africa. We're seeing the cars that have been manufactured in South Africa coming under pressure. And Metair does supply some of the OEMs in South Africa. So yeah, a difficult time for them. Yeah, I mean, we don't own Metair, and I guess we wouldn't be buying it now. So yeah, perhaps time to look at something else in your portfolio.
Okay, what about you, Shane? What are your thoughts around Metair?
So I guess my question would be, what is the unique selling proposition that Metair is bringing to an investor's portfolio? And when I look at the JSE, I see plenty of other mid and large cap companies that trade on equivalent or cheaper valuations with less operational risk and less balance sheet risk. So, my assessment of this is that there are better opportunities simply because you get better liquidity and lower risk in larger companies.
Okay, what are some of those counters?
Well, I mean, take Truworths. We were talking about the retail sector.
Okay.
Truworths is on an 8 PE, 8% dividend yield. You can buy Nedbank at book value or a little bit below book value, also on an 8% dividend yield. I don't know why you would stray into a risky investment when you can get an 8% dividend yield in a large cap.
All right, fair. All right, I'm going to get into your stock picks now. Shane, where are you seeing value at the moment? I know you just gave us a few picks, but I'm sure that is not your stock pick today.
Okay, well, I'm going to go with two just quickly because I think it's interesting. The turnover on the JSE at the moment has gone from 20 billion to 50 billion a day nearly. And the JSE is a listed company. You've got to have a look at that. And then the other one I'm going to go for, which is a safer harbor, I think, is Renet.
Okay.
Renet's trading around 540. It's got about 570, 580 in cash once this deal with Pension Corp closes. The total NAV discount is probably about 25%. And they've said that they will resolve what they're going to do with the company in the first quarter, which we are halfway through now. Mm-hmm. And my judgment is that this company will be wound up and delisted.
Huh. What about you, Mark? Where are you seeing value at the moment?
Yeah, so tonight I'm buying We Buy Cars. So last month, towards the end of last month, we saw the founders selling quite a large stake of their holdings. And I think that the market is unnecessarily worried about this. I mean, they have said that it is to diversify their portfolio, and maybe with the rand being as strong versus other currencies what it is, they want to maybe externalize some of their money. I think that at the current share price, it shows value. We think that earnings can grow in the high teens, and you get a 2% dividend yield. There is some temporary slowdown in earnings because of the cheaper Chinese vehicles which are coming into South Africa, putting a bit of pressure on the second-hand car prices. But ultimately, more cars in the car park means more business for We Buy Cars, and we think that they'll continue to take market share. And at this price, I think it's a good entry point.
All right, gents, thank you so much for your time and joining us this evening. That's all for Stock Watch today. Thanks to my guests, Mark Du Toit from Oyster Investments and Shane Watkins from All Weather Capital. Up next, it's The Close.
Thank you.